The Singapore market in 2020. What are the global events that would affect Singapore? What caused the buying trend to actually spike up in the last 3 quarters of 2019 despite the fall in 2018 after the cooling measures? Who are the people buying? Would you like all these questions answered? I answer them for you one by one in this video, which I'm sure would be very useful for you. Would you like to know all the answers? Keep watching. First, to understand the situation now, I want to rewind us back a couple of years ago when the market was going up in 2017. If you recall, the market after 2013, when TDSR was introduced, started to drop for 4 years until 2017, in about the middle of 2017, when the market started to spike up, mainly because of en bloc. Went and rose about 10% over 5 quarters. Then abruptly, in the middle of 2018, July, the government increased the additional buyer stamp duty and made it harsher for developers looking to buy land. Then the market dropped for about 2 quarters. Interestingly, people who thought that the market would drop further after those cooling measures, they were disappointed, because in 2019, from the second quarter onwards, the market actually rebounded, which left many people scratching their head. So who exactly were these buyers and why were they buying? To explain this to you, we need to look at a major event that happened to the world in 2018. That was the US-China trade war. As this chart shows very accurately, the trade war started in about January 2018, and when it first started, people were unsure. They thought it was a flash in the pan. They did not know how long it would actually last. Fast forward 2 years later, 2020, and the tariffs have risen from about 3% for the China imports into US till today, where it's about 19.3% on average. That is almost a 700% increase. What you may not have noticed is that in response to that, what the China government has done to make sure their exports remain competitive is to devalue the Chinese yuan. This is the other graph that shows detail. In 2018, when the trade war first started, the USD, $1 USD was worth about 6.3 China yuan. Today, in 2020, it is worth 6.9 Chinese yuan. That means the Chinese yuan has devalued by almost 10% over a 2-year period. Wow, 10% may not seem like much on its own, but when it's taken over a huge sum of money, like the millions, billions even, that are owned by some of the rich Chinese people, it is a huge dent on their finances. Someone who's a billionaire 2 years ago may become a millionaire today because of this devaluation of the Chinese yuan. So what have they done in response? If you're aware, the Chinese government imposes strict rules on funds exiting China. Interestingly, since the first half of 2018, there has been a gradual increase in the uncaveated transactions. What does that mean? That means there were no caveats lodged for these purchases. Banks are usually the ones who lodge these caveats, and maybe these buyers did not take loans, so their nationalities are unknown. As we see from the statistics, in first half 2018, it was 135, then increased to 177, then to 240, and finally to 684 in the second half of 2019 alone. A huge spike itself in the second half of 2019. Maybe that does help to explain why our property index rose in the second half of 2019. When we compare the full year transactions for 2018 and 2019, we will notice that year-on-year figures, 2019 actually had a drop of about 2,600 units over 2018. However, when you only take into account the second half of the year, you will find that in 2019 there were 853 more transactions than 2018. Very close to the 684 figure we see here, isn't it? Now, this is just an assumption, but if we assume that the Chinese buyers form the bulk of the unspecified uncaveated purchases, in 2019 alone, quarter by quarter, they have actually increased as a percentage of all transactions. Chinese would have purchased 8.7% in quarter 1, 9.2% in quarter 2, 10.1% in quarter 3, and 12.3% in quarter 4. So I think that gives us an idea of who are the buyers in the market right now helping to drive up prices. Moving on, you'll ask, would this continue in year 2020? Latest news report that US-China Phase 1 trade deal to be signed on January 15. Do you think that it would actually work out and reduce tensions within the nations? Here's what an article published by Bloomberg had to say, that the US-China trade war could get hot again, and we should not in any case overestimate this first agreement. After all, President Trump is still a bit of an uncertainty, and with the existing high tariffs still being imposed on Chinese goods, it's certainly uncertain whether this would be able to be resolved. Therefore, if you've watched my previous Singapore property market update, you will know that the Singapore economy and real estate market is a very resilient and stable market which attracts inflows not just because of our strong institutions but also because of our strong Singapore dollar. So much so that unrest or uncertainty happening around the world is in fact in Singapore's benefit, as it has also been reported by many banks, asset managers, funds that capital inflows into Singapore has also increased greatly over the last year. For private home prices, Fitch, one of America's big 3 credit rating agencies, in fact reported that Singapore's private home prices is set to grow 2% in 2020 and 2021. So what does this mean for you and I, for own stay buyers and for investors? In summary, don't expect the prices to drop in 2020. Inflows from around the world into our economy, as well as real estate from foreign countries, especially China, should help to keep our real estate market strong. And what about cooling measures? Because 2019 was untouched by the government, are we expecting any in 2020? In my view, because the election is coming, the government would be wary to tweak any measures which might impact their approval ratings. Any easing measures are certainly unlikely, and what we might have is an additional cooling measure by the government, especially if the market heats up too much from all these inflows. For own stay occupiers, don't be afraid of the oversupply you often hear in the market. As a buyer, do you want to buy when the supply is high or when the supply is low? Do you want to buy when you have a lot of choices or when you have no choices? In today's market, this presents the best opportunity for you to actually choose your desired units in a variety of developments that provide good value and comfort for owner occupation. For investors, as the saying goes, the best time to buy real estate was yesterday. Second best time is today. I've had chats about this with a lot of my friends and clients as well, and yes, I agree that the market is not as hot as last time. We won't be able to make as much gains on real estate as years before, but it is still a very stable and reliable investment option for the long term. So don't be afraid of the pricing. There are always gems available in the market with good upside. Get invested and stay invested for the long run. Just remember 2 fundamental rules. Number 1, rentability equals to sellability equals to profitability. Make sure your property is rentable, otherwise it wouldn't be sellable. And if it's not sellable, there's no way you can get any profit out of it. The next is to always take note of the entry price, because profits are made when you enter and not when you exit. I leave you with 2 words for your property endeavors in 2020. Tread wisely. Once again, my name is Jim Tay, and if you like any professional real estate advice, feel free, drop me a personal message, an email, like this video, share and leave a comment, and I'll see you in my next video.